In September 1873, the collapse of financier Jay Cooke's empire triggered a massive panic. The crisis revealed a fatal flaw in the American economy and inspired a radical idea: a lender of last resort, the concept that would lead to the Federal Reserve. Jay Cooke was the titan who financed the Union's Civil War effort by selling bonds to the public. Afterwards, his firm, Jay Cooke and Company, bet everything on financing the Northern Pacific Railway. But America was in a credit boom built on fragile confidence. When Cooke's ambitious railroad project struggled to sell bonds, his firm was left dangerously exposed. A stock market crash in Vienna spooked European investors, cutting off funds for American railroads. For the overextended Jay Cooke, the timing was catastrophic. On September 18, 1873, his firm went bankrupt. Panic gripped Wall Street, shutting down the stock exchange for 10 days. A chain reaction of bank runs plunged the U.S. into a severe depression, revealing a system with no one to stop the financial contagion. Remarkably, in that same year, English economist Walter Bagehot published Lombard Street, which held the answer. He argued for a lender of last resort to stop panics. The core strategy to lend freely to solvent but cash-strapped banks at a high penalty rate, and only against good collateral. The goal wasn't to bail out bad banks, but to save the system from a crisis of confidence. This led to creation of central banks like the Reichsbank in Germany. The US was slow to learn this lesson. Without a central bank, devastating financial panics struck again in 1893 and 1907. The 1907 crisis grew so severe that it required a private bailout organized by banker J.P. Morgan to save the economy. After relying on a single citizen to avert disaster, Congress was finally spurred to action, creating the institution that would become the Federal Reserve.